we talk to policymakers is they kind of expect that the Federal Reserve will bail them out, right? If things go sideways. And there are many different ways that the Federal Reserve will do that, including the purchasing of debt. Um, is there a point that you could see where the tools in the toolbox for the Federal Reserve to maintain stability, to avoid inflation and other challenges like that eventually run out, or you hit some sort of checkmate where Congress has to act?
Well, the Fed has limited tools. And in a situation where the primary policy tool, which is the policy interest rate, the federal funds rate, reaches zero or effective zero, it's got what's called the effective lower bound. In recent years, twice in recent years, or at least going back to the 2008, the Fed has used quantitative easing or the purchase of Treasury securities as a tool to try to put pressure on longer term interest rates to stimulate the economy. And I would say to some extent that violates what is a clear ethic in central banking, and that is monetization of debt is a no-no. You just don't do it as a central bank, and respected central banks around the world stay away from the outright explicit monetization of the fiscal side's mistakes or tendencies. And yet, arguably, that's exactly what happened. The invocation of quantitative easing was not intentionally to monetize the debt. It was to add stimulus, but it had the effect of the Fed buying a lot of treasuries and certainly giving some policymakers the feeling that the Fed is always there with a big cannon that it can deploy to deal with any kind of crisis. I would say using that tool is a crisis, or let's just say a deep recession kind of response. It's not in the normal course. By far, the most important policy tool is the interest rate. So are there limits? There are limits on what can be achieved that way. And secondly, clear limits in terms of the circumstances in which the Fed would actually use that tool.